Preparing for a portfolio analyst at BlackRock interview. You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How would you describe the role of a portfolio analyst at BlackRock? At BlackRock, a portfolio analyst sits between markets, portfolio managers, risk, trading, and clients. My job is to turn portfolio data into decisions, exposures, performance drivers, liquidity, constraints, and risk changes. I would monitor whether portfolios match objectives, flag unintended bets, support rebalancing, and explain outcomes clearly. The value is not just running reports, it is connecting analytics to investment judgment and client outcomes under market pressure. While answering, focus on the analyst as a bridge between portfolio management, risk, trading, operations, and clients. Mention exposure monitoring, performance analysis, investment process support, and fiduciary discipline. Question 2. Walk me through how you would analyze why a portfolio underperformed its benchmark last month. I would start with active return, portfolio return minus benchmark return. Then I would decompose it into allocation, selection, currency, duration, curve, spread, or factor effects depending on the asset class. If a portfolio lagged by 80 basis points, I would ask whether that came from an intentional overweight, poor security selection, trading costs, or market timing. The key is separating noise from a repeatable issue in the investment process. Make sure to cover performance attribution, benchmark relative return, sector or factor effects, security selection, currency impact, fees, timing, and whether underperformance came from intended or unintended risks. Question 3. What risk metrics would you monitor daily for a multi-asset portfolio? For a multi-asset portfolio, I would monitor absolute and relative risk. That includes volatility, tracking error, beta, VAR, drawdown, factor exposures, liquidity, concentration, and currency exposures. For fixed income sleeves, I would add duration, spread duration, curve positioning, and credit quality. I would also run stress tests, because a portfolio can look diversified statistically, but still be exposed to the same macro shock, such as rising real yields. In your answer, talk about volatility, tracking error, beta, value at risk, drawdown, factor exposures, liquidity, concentration, duration, currency, stress tests, and how daily monitoring supports portfolio managers. Question 4. How would you use BlackRock's Aladdin platform in a portfolio analyst role? Aladdin is powerful because it links portfolio positions, risk analytics, trading workflows, and compliance in one environment. As a portfolio analyst, I would use it to monitor exposures, review risk factor contributions, run stress scenarios, check portfolio guidelines, and support rebalancing decisions. The important part is not just pulling numbers from Aladdin, but interpreting them, what changed, why it matters, and whether the portfolio still reflects its mandate. Be sure to mention Aladdin as a risk, portfolio management, analytics, and operational platform. Discuss exposure reporting, scenario analysis, compliance checks, order support, and cross-team communication. Question 5. Explain tracking error and why it matters for a portfolio manager. Tracking error measures how much a portfolio's returns deviate from its benchmark over time. For an index strategy, low tracking error is critical because the objective is close replication. For active strategies, tracking error shows the amount of active risk being taken to generate excess return. I would compare it with active return through the information ratio. High tracking error is not automatically bad, but it must be intentional and consistent with the mandate. While answering, define tracking error as volatility of active returns. Explain benchmark relative risk, active management constraints, information ratio, unintended bets, and why different strategies tolerate different levels. Question 6. If a portfolio has a high tracking error but low active return, what would you investigate? High tracking error with low active return tells me the portfolio is taking risk without being compensated. I would break down tracking error by source, sectors, securities, factors, currency, rates, or credit spread. Then I would compare those sources with realized alpha contribution. If one overweight explains most of the risk, but not the return, I would escalate it to the portfolio manager and discuss whether the position size still makes sense. Make sure to cover whether active risk is being rewarded, factor or sector bets, concentration, benchmark mismatch, transaction costs, security selection issues, and potential portfolio construction changes. Question 7. How did interest rate changes affect a fixed income portfolio? Interest rate changes primarily affect bond prices through duration. If a portfolio has duration of 5 years, a 100 basis point parallel rate increase roughly reduces price by about 5% before convexity and spread effects. But the curve rarely moves in parallel, so I would also analyze key rate duration across maturities. For credit portfolios, rates interact with spreads because tightening spreads can offset some duration-driven price losses. In your answer, cover duration, convexity, yield curve shifts, reinvestment effects, credit spreads, and how portfolio analysts assess sensitivity across government, corporate, and securitized bonds. Question 8. What is the difference between absolute return and relative return analysis? Absolute return asks, did the portfolio make money? Relative return asks, did it outperform the benchmark or target? A long-only equity fund may be judged mainly relative to the MSCI World, while a hedge-style or outcome-oriented portfolio may focus more on absolute return and drawdown control. I would still look at both. A portfolio can beat its benchmark, but lose money, which may not satisfy a client's real objective. Be sure to define both clearly and connect them to mandate type. Mention benchmarked portfolios, client objectives, risk-adjusted performance, and why both perspectives can matter at BlackRock. Question 9. How would you approach rebalancing a portfolio that has drifted away from target weights? I would first quantify the drift versus target weights and tolerance bands. Then I would check whether the drift creates material risk, benchmark, liquidity, or guideline issues. Rebalancing is not mechanical. I would consider transaction costs, bid-ask spreads, tax constraints where relevant, cash flows, and market conditions. If equities rallied and became overweight, I might use incoming subscriptions or dividends before selling, reducing turnover, while bringing the portfolio back in line. While answering, discuss target allocation, tolerance bands, liquidity, transaction costs, taxes if relevant, market conditions, risk impact, cash flows, and coordination with trading and compliance. Question 10. What is factor exposure, and how would you explain it to a non-technical client? Factor exposure means the portfolio's sensitivity to common drivers of return. In equities, examples include value, momentum, quality, size, and growth. In fixed income, factors include rates, credit spreads, curve shape, and inflation. To a non-technical client, I would say, two portfolios can own different securities, but still behave similarly if they share the same drivers. Factor analysis helps identify hidden concentrations that may not be obvious from holding names. Make sure to cover common factors such as value, growth, momentum, quality, size, rates, credit, and inflation. Explain exposures as underlying drivers rather than individual holdings. Question 11. How would you evaluate liquidity risk in a portfolio? I would evaluate liquidity at both the security and portfolio level. At the security level, I would review average trading volume, bid-ask spread, issue size, dealer depth, and time to liquidate. At the portfolio level, I would compare liquidity with potential cash needs, redemptions, margin calls, or rebalancing requirements. The key is stressed liquidity, because assets that trade easily in normal markets may become expensive or impossible to sell during volatility. In your answer, discuss bid-ask spreads, trading volume, days to liquidate, market depth, asset class differences, stressed liquidity, redemption risk, and avoiding forced selling during volatility. Question 12. What does performance attribution tell you that a simple return number does not? A return number tells me what happened. Attribution tells me why. If a portfolio returned 2%, I need to know whether that came from sector allocation, security selection, currency, duration, credit spreads, or factor exposures. Attribution also helps test the investment thesis. If a manager claims skill in stock selection, but returns are driven mostly by sector bets, that matters. Good attribution turns performance into feedback for portfolio construction. Be sure to mention attribution as explaining sources of return. Cover allocation, selection, interaction effects, factor attribution, fixed income attribution, and how it informs future investment decisions. Question 13. How would you think about portfolio construction for an iShares ETF or index portfolio? For an iShares or index portfolio, the objective is efficient benchmark exposure. Full replication may work for liquid equity indices, but sampling may be better for broad fixed income or illiquid markets. I would focus on tracking difference, tracking error, liquidity, transaction costs, corporate actions, and index changes. Portfolio construction must also handle creations and redemptions smoothly. The goal is not to outperform aggressively. It is to deliver the index exposure reliably and cheaply. While answering, connect the question to BlackRock's iShares franchise. Discuss index replication, sampling, tracking difference, liquidity, transaction costs, corporate actions, creations, redemptions, and benchmark methodology. Question 14. Suppose markets sell off sharply. What would you do first as a portfolio analyst? In a sharp sell-off, I would first verify data quality and current exposures because bad data leads to bad decisions. Then I would check risk limits, guideline breaches, liquidity, margin, cash needs, and largest contributors to losses. I would run stress and scenario updates if markets are moving quickly. Most importantly, I would communicate clearly with portfolio managers and trading what changed, where the vulnerabilities are, and what actions are available. Make sure to cover calm prioritization, exposure checks, liquidity, guideline breaches, risk limits, cash needs, client reporting, stress testing, and communication with portfolio managers and trading. Question 15. How do you assess whether a portfolio is diversified? Diversification is not just owning many securities. I would look at correlations, sector weights, issuer concentration, factor exposures, geography, currency, liquidity, and scenario behavior. A portfolio with 200 stocks may still be concentrated if most are high-growth technology names. I would also test diversification under stress, because correlations often rise when markets fall. The practical question is whether different parts of the portfolio can offset each other when it matters. In your answer, go beyond number of holdings. Mention correlation, factor concentration, sector exposure, issuer concentration, geography, liquidity, scenario behavior, and diversification that holds under stress. Question 16. What is the difference between VAR and stress testing? VAR estimates the potential loss over a defined horizon at a given confidence level, such as one-day 95% VAR. It is useful for summarizing risk, but it depends heavily on assumptions and may understate tail events. Stress testing asks what happens under specific shocks, like a 2008-style credit crisis or a sudden rate spike. I would use both, VAR for routine monitoring and stress tests for understanding extreme but plausible outcomes. Be sure to define VAR as a probabilistic loss estimate and stress testing as scenario-based analysis. Mention limitations, tail risk, historical scenarios, hypothetical shocks, and portfolio decision use. Question 17. How would you explain the difference between duration and spread duration? Duration measures sensitivity to changes in interest rates, while spread duration measures sensitivity to changes in credit spreads. A treasury portfolio mainly has rate duration. A corporate bond portfolio has both rate duration and spread duration because prices move when treasury yields change and when investors demand more or less credit compensation. If spreads widen by 50 basis points, a high spread duration portfolio can lose value even if government yields are unchanged. While answering, define duration as sensitivity to interest rates and spread duration as sensitivity to credit spread changes. Use examples for government bonds versus corporate bonds. Question 18. Tell me about a time you found an error or inconsistency in financial data. What did you do? In a portfolio analyst role, data integrity is non-negotiable because small errors can distort exposures or client reporting. I would describe the issue, how I identified it, and how I validated the correct number through source files, custodians, pricing feeds, or trade records. Then I would explain how I escalated it, documented the root cause, and improved the process. The best answer shows ownership, not just error spotting. Make sure to structure the answer with situation, action, result. Emphasize data integrity, reconciliation, escalation, root cause analysis, documentation, and why accuracy matters in portfolio analytics. Question 19. How would you prepare a market view for a portfolio manager before an investment meeting? I would keep it concise and portfolio relevant. I would summarize major market moves, macro data, central bank expectations, rates, inflation, earnings, credit spreads, valuations, flows, and positioning. Then I would connect those observations to portfolio exposures, which risks helped, which hurt, and what could matter next. A portfolio manager does not need a news recap. They need implications for risk, positioning, liquidity, and client communication. In your answer, discuss macro drivers, rates, inflation, earnings, credit spreads, valuations, flows, positioning, risks, and translating market information into portfolio-relevant implications. Question 20. Why BlackRock, and why this portfolio analyst role? BlackRock appeals to me because it combines scale, technology, risk discipline, and a fiduciary mindset. The firm influences markets across active, index, ETF, fixed income, and multi-asset investing, so a portfolio analyst can learn how decisions are made across a global platform. This role fits me because I like translating data into investment insight. I want to support portfolio managers with accurate analytics, clear communication, and strong risk awareness. Be sure to tailor this to BlackRock's scale, fiduciary culture, Aladdin, iShares, global investment platform, risk discipline, and desire to combine markets, analytics, and client outcomes. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.